I wanted to come to like the nice part of San Rafael and show you guys that it's not all drugs and homeless or whatever, because right now I'm on the corner of Lac Navarre and Inverness, and we're gonna walk around here. This is kind of right across the street from the marina that I did the video at a few weeks back. So very nice area, very peaceful over here, very quiet. You know, we're gonna talk about for a little bit why the 1% down mortgage might actually be a good thing. Because that's what I keep hearing, guys. I keep hearing that this is going to be a positive for the housing market and not a negative. And there was a story on this today, so I want to get into this with you guys and digest some of this to see if any of it is actually true. Now here's what it says. It says that to drum up business, some lenders have positioned various products to entice homeowners, particularly allowing buyers to put down just 1%. Lenders say they're trying to make homeownership more affordable for the prospective home buyer. Now, we already know that United Wholesale Mortgage and Rocket Mortgage have been offering this since May this year, and recently Zillow just jumped on the bandwagon about a month ago. And all these mortgage companies are claiming that they're doing this to help out potential home buyers to get their foot in the door with the housing market, but because without a program like this, it just wouldn't be possible. That's their claim or their excuse of why this is a good idea. Now, according to Redfin, which I don't know if I can trust anything they say anymore after what I've been seeing lately, but anyhow, they say that the typical US home buyer is putting down $42,000 on their purchase, which is equal to about 10% of the median home value. And many young people don't have that money, so they rely on the bank of mom and dad to get that 42 grand for a 10% down payment. Now here's what's really going on behind the scenes with this, okay? Mortgage originations this year are projected to reach $1.7 trillion in 2023. That's down an estimated 60% from 2021. So what's happening right now is the mortgage industry, and real estate for that matter, is absolutely getting crushed. Now, mortgage industry is even bigger trouble right now than real estate, because at least real estate transactions can still move forward with people that actually have cash or who are willing to take out these mortgages. So lucky real estate agents are still able to close those type of deals, but mortgage lenders rely entirely on mortgage origination. So if people aren't applying for mortgages and taking those loans, they don't make any money. So that sector of the real estate market right now is particularly more vulnerable than somebody who sells real estate. So what these companies are doing is they are finding ways to get people into mortgages, even though they basically can't afford it, guys, but they're trying to put together these creative programs to make it so they can afford it. And basically what they're doing is they're using this 1% down as a way to funnel people in to the mortgage business right now and get people through the door. They need people applying for loans and getting them. And one of the ways that they're able to do that is through these programs for people that would normally be completely priced out, and they can find a new segment of the market for people to go ahead and get a mortgage. So this is a positive thing, right? Because they are letting people in that would never have a chance otherwise. Aren't they just the heroes of the day? But in here, there's a story about a man that back in 2007 was making about 60 grand a year, and he owned 5 investment condos, okay? How is that possible? Well, because back then they had ninja loans, no income, no job, no assets. That was basically the acronym for that type of loan, where anybody with a pulse back in those days could get a mortgage. And I am not saying that that's exactly what's happening today, because the underwriting standards are stricter than they were back then, but it's starting to fall apart now when you're starting to see people able to put down just 1% and get into a home. And so this guy from back in 2007, he said, oh, prices only go up, and they're not checking my income, and I'm making money, so don't worry about it. And then after the Great Recession hit, this guy declared bankruptcy and lost everything. So this can easily be the story this time around as we head into this recession, guys. And this is not me saying this, okay? The Fed just told everybody that people are going to be out of money by the end of October, essentially. So that's in like a month from now. Then savings are gone. So when the savings are gone, the debt bubble balloons even more. People will borrow more until they can't borrow more, and then the whole thing collapses onto itself unless there's further stimulus from our government and the Fed. Now, even though the underwriting standards are stricter now than they were back in 2007, the whole principle is the same, that these are basically subprime loans because people have no skin in the game. There's no equity. So it makes it very easy for someone in this position to, first of all, go underwater on their property when home values start declining, and they don't have to decline by much to be underwater when you only put a 1% down payment. And it has basically the same risk profile because you're giving somebody that has a low income the ability to buy a home that normally wouldn't be able to. So essentially they can't really afford the home, but they're making an exception because they're making a similar payment now, only they're paying rent instead of actually paying a mortgage. So they're saying, well, it's basically the same thing, which it isn't, by the way, because when you pay rent, you only have to pay the rent. And when you own a home, there's a million other expenses that come along with it. So it's not the same at all. But these lenders are painting the picture that it is to make it so that people can get these loans. And now they're the saviors, you know, because of them, these people are getting houses for now until they can't make the payment anymore. And so the defense from the lending side is that they're breaking down the barriers for people that normally would be locked out of the housing market, which they are. Don't get me wrong, that's exactly true. They are doing that. However, the piece of the puzzle that's missing here is that this type of program is only going to work for people who are financially responsible, okay? I'm not saying that everybody puts 1% down is going to default and end up in foreclosure in the near future, okay? But I am saying that someone who is not in a good income situation and doesn't have any money saved is probably at a higher risk of default than somebody who has a 20% down payment saved and has an 800 credit score. Because the only other requirement that somebody needs to meet here is they need to have only an 80% of the local median income, number one, and they need to have a minimum of a 620 credit score, which once again, guys, that's not a great score. It's okay, it's not terrible, but it's definitely not great. Now, Bob Walters, he's the CEO of Rocket Mortgage, and he said this. He said, "We talk with people from all walks of life every single day, many of whom are ready to own a home and could easily make the monthly mortgage payments but are having trouble saving for a down payment." But what they're really doing is they're putting these home buyers in a very risky position because it's not a matter of if the housing market will decline, it's just how much and when. It's kind of like more the realistic scenario of where this is headed right now. And those people are going to be the first one basically can't sell, guys. If they face any type of trouble, okay, even not even just a job loss, let's say, you know, they get a medical bill for $5,000 and now they're in distress because, well, they couldn't even save the $5,000 to put down on the property, they're going to be in big trouble. The moment they can't pay, they get foreclosed on. But if anything happens, these guys are going to be the first ones to lose their homes because they have no equity to fall back on, okay? That's one of the main advantages of putting a 20% down payment. You don't pay PMI, which is private mortgage insurance, so it'll save you some money there, but also it is like a cushion for you. So if the housing market does tumble, you are not going to be completely upside down on your mortgage like people with the 1%, even 5%, even 10% down, which is the average, guys. 10% is not bad. I'm not saying it is, but in an environment like this, where home prices have already declined by more than 10% in several markets throughout the country, that puts you in a vulnerable place. Think about it. Anybody who put down a 10% down payment a year ago in Austin, Texas, or Boise, Idaho, or San Francisco, places like that, where home prices have come down double digits already, they're upside down, even with a 10% down payment. So that is not a guarantee that you're going to be able to just ride this thing out by putting 10% down. But 20% is a much bigger cushion. Could it go down by 20% or more? Absolutely. But you're just giving yourself more protection in that case. So they're also defending this and saying that 1% mortgages are such a good thing because this is not predatory lending, because it's not so much about how much you put down as a down payment, but it's more a question of whether or not you have the credit quality and have the financials to honor the terms of the loan. Now, that's a fair point. And like I said, the lending standards are probably better than they were 15 years ago when it comes to that sort of thing. However, it doesn't guarantee that somebody doesn't default, because these lenders or the person getting the loan is not in charge of where the economy goes next. And right now there's just all these warning signs that it's not going to be going to a good place by the end of the year, and they're writing 1% mortgages, guys. Is it a good thing for some people that are going to be able to hang on through this? Yeah. Some people want to hear good news. It's good news, guys, that some people that take advantage of this are going to win, and they're going to get on the property ladder thanks to the 1% down mortgage that they wouldn't have otherwise been able to get, and they'll do whatever it takes to hang on to that house. There's going to be a small percentage of people that do that, and it's going to change their life for the better, and I'm happy about that. But for the vast majority of people that get into these programs, I think the opposite is going to happen, unfortunately, just because that's what we've seen happen in the past. It's not like it's my opinion or anything. It's just that that's what history has shown us. When you give people too easy access to something and too much free credit, then there's no skin in the game. And as soon as things start heading south, they just walk away. That's exactly what you're seeing all of these big companies and institutions do right now with the commercial office buildings that are sitting vacant, and they're upside down on those loans, guys. And these are big companies that have a lot of money, and they're choosing to give these properties back to the bank, like by choice. So if people in that position are willing to do that, imagine other people that literally only had to pay like $3,000 for the house, less than you would pay to get into a rental. You think they're going to be fighting to save that? Probably not. So the real test of financial responsibility, in my opinion, is a higher credit score and somebody that has the 20% down payment. Because you think somebody that saved all that money to put down, if 10% is the average at 42 grand, that means 20% on average is $84,000, guys, down payment. Somebody that has the ability and the financial wherewithal to save up 85 grand to buy a house, they have what it takes most likely to hang on to that house. And when things do go south, they're much more likely to hang on to that house because they put their whole life savings into it. And basically what they're doing is they're just setting people up for foreclosures, guys, in the future. So we talked about yesterday how there's all this pent up demand for people that wish they could sell right now, but they're not. But then you're going to have all these people that need to sell, not because they want to, but because they have to. And I'm afraid that these 1% mortgage folks are going to be in that category. Now, another thing that these lenders are not mentioning here about this being such a great thing for home buyers, which I kind of touched on there, is the actual cost of owning a home. Okay? Newsflash, it's not just the mortgage payment that you have to pay in order to hang on to the house. So yeah, maybe their mortgage payment is similar to what they were paying in rent, but so what? Because now you have an additional $1,000, $1,500 a month on top of that you didn't have as a renter. And if you couldn't afford to put down, $5 grand on your house payment, are you going to be able to afford that extra $1,000 or $1,500 a month is what I want to know. And if you think I'm just being harsh on people, guys, I'm not. I'm coming at you from the perspective of being a fellow homeowner, somebody that has been a landlord and has dealt with rental properties and has seen expenses rise and go up. And I know the challenges that you face when it comes to owning real estate, guys. I'm very familiar with this stuff. So it's not like I'm just making this up and saying that people are going to have all this extra things to pay for, because I know for a fact they will. I found an interesting story on this today on how much it really costs to own a home. And these are all just going to be obviously broad average figures, guys, because there's no one way to nail down exactly how much it costs to own a home, because obviously it's going to greatly depend on where you buy a house. If you buy a house here in this neighborhood, it's going to cost a lot more to maintain and pay for over the years than if we buy a house in the Midwest. So let's just be real about that. But according to the credit building company called Self, they did a study and they determined that the average American home, the cost to own is about $623,290 to own that home over the property lifetime. And guess what? You know what the property lifetime is? You think it's your 30-year mortgage? That's just for the average 13.2 years that they think that you'll live in the home. Okay? So you're talking $623,000 over the course of 13.2 years, and that's just the average. So if you're somebody that wants to do one of these 1% down payments, you need to take a long, hard look at that average number and say, can I afford that? Because if you can't, then you might as well just walk away while you're ahead, guys, and keep renting and keep saving until the time's right for you. Because one day the time will be right for you, but today's not it. And the reason I bring this up is because this was a study done in all 50 states. This number includes not just your closing costs and the cost to purchase the house, but it also factors in your mortgage payments, your insurance, your ongoing maintenance with the house, your utilities such as gas, electric, water, your internet bill, all of that. $623,000 is the average. So if you want to fast forward it to a 30-year term, you're going to be looking at well over $1.3, $1.4 million just for the average person. And of course, the most expensive states for this are California, Washington, Massachusetts, Hawaii, and Washington, D.C. And the least expensive areas to own a home over the lifetime is West Virginia, Mississippi, Oklahoma, Ohio, and Iowa. So like I said, you're going to the Midwest, it's going to be a different story. Just your mortgage payments alone break down to $322,147 over that 13.2 year period. That figure includes your private mortgage insurance, if you have it, your homeowner's insurance, and your property taxes. You can pretty much guarantee that that figure is actually going to be higher for you if you're buying today. Here's why. Property insurance is going through the roof practically everywhere. That's the number one reason. And also, you're going to be the lucky buyer to buy today at all-time high prices, which means you're going to pay all-time high property taxes as well. Because when you buy a property, the new value of the property is assessed based on what you purchased it for. And I've showed you guys numerous examples in my videos of situations where people bought a property and then the property taxes absolutely skyrocketed when it got reassessed. That's a common thing. And check this out, guys. What else does it say here in this story? There are several ways to reduce homeownership costs, such as a larger down payment. What did we talk about earlier? More efficient appliances, alternative energy strategies, and do-it-yourself repairs. Then of course, refinance when rates are low, assuming you have the equity to do so. So I'm really glad I came across this because I wanted to make sure everybody out there that's on the sidelines right now fully understands how much it really costs to own a home, guys. And I can attest to this, and I think it's much more expensive, especially if you're gonna live in these more expensive areas. You can probably double all these numbers I just gave you, and that's gonna be the more realistic picture of what it costs to own a place. And I would just tell you that there's no shame in renting if you're saving a significant amount of money right now, so long as you're putting aside that money and saving to become a homeowner one day, if that's your goal. If you want to own a home, but you feel like you can't afford it yet, and you're saving a lot of money renting, just keep saving and waiting, because it's going to pay off. Now this house might be an interesting one to keep an eye on if I'm still here, because it's a coming soon listing. It's not listed yet, but according to Redfin, they estimate that this house, it will be listed and sold at around $1.7 million, and the estimated sale price is anywhere between $1.63 and $1.94 million. So it'd be funny to see just how close or off base they really are. But they bought it back in 1993 for only $415,000. As you can see, people in this area have massive amounts of equity and they are cashing out, and I don't blame them. And speaking of payoffs, here's something funny that I came across, which I've never heard of before, but is quite interesting when it comes to payoffs and credit scores and owning houses. Take a look at this. Here's somebody that had an 850 credit score, which is a perfect score. You can't have a higher credit score than that, okay? And that's your FICO score. They paid off their mortgage. After 2 months of paying the mortgage off, their credit report dropped 24 points to an 826. Now, this is not something to be alarmed about or freak out about, because an 826 is still an excellent credit score. But here's the interesting thing. Because that debt profile finally got erased from their credit report, they're not paying on this anymore, their credit score actually went down. And this has happened to other people through other types of loans, like when they pay off an auto loan, their score went down by 30 points. So if you pay off any type of big ticket loan, your actual credit score can go down. And I remember this happened to me actually a couple years ago when I sold one of our last investment properties, and you know, the mortgage was paid off, and actually my credit score took a hit. I think it probably went down about 20 points. It wasn't quite as dramatic, but it did go down. Here we have a house for sale with a pool for $2.699 million, and they started off asking $2.85 million. So they've already cut the price about 150 grand since the end of July. So it's a pretty fresh listing, about a month and a half old, $150,000 price cut. So they probably want to sell it. But I don't know who can afford to buy a house like that in this economy. So let's see if it sells. We'll keep an eye on it. But this is how you make money in real estate, folks. These guys have had this house for the past 25 years, and they paid $600,000 for it back in 1999. So if you really want to see these type of gains in real estate, you have to be in it for the long run. So what's going on here when you see these credit scores drop and paying off all these loans is because the credit score algorithm uses your payment history, the amount you owe, your new credit, the length of credit history, and your credit mix, the type of different loans that you have, to formulate your credit score. And so when you pay off a big loan like this, it kind of jumbles up that algorithm and causes this kind of hiccup. And because each category is weighted in its own way, your payment history alone is 35% of your credit score. Another 30% of your score is credit utilization. And so mortgages, for example, are in several credit categories, like your length of credit history, your credit mix calculation, and your payment history. So when you pay this off, it kind of messes this whole thing up. And so once you pay off the loan, it's no longer in your credit mix category. And the algorithm basically finds it that when you have a low installment loan balance to loan amount ratio, you are a little bit less risky than having no active installment loans at all. Isn't that funny, guys? When you live debt-free, you're considered a higher risk than somebody that actively has ongoing debt. Isn't that something? So I think it's like stories like this that kind of perpetuate that old myth that we all used to hear about, oh, you should charge your credit card and always have a revolving balance on it and pay that interest. That way you can have a higher credit score, which is totally not true. Okay, that's a big fat lie that people have been told, probably started by the credit agencies to make a ton of money off of you. But the reality is you can take a hit on your credit score if you pay off a big loan, because the credit companies look at you as more of a risk when you have no installment debt versus somebody that doesn't. Just a quick tip for you, don't get alarmed, and also don't be discouraged to pay off your loan, because when you are going to get a loan for something and your lender's looking at your credit score and you have an 826 versus an 850, it's going to be no difference, guys. You're already in the excellent category, which is the highest category you can be in. So as long as you're keeping your credit score there, you'll be good to go. If you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.